Module 1. Introduction to Financial Systems, Markets, and Institutions. Learning Outcomes. By the end of this module, students should be able to understand the role of financial systems in the economy, distinguish primary versus secondary, money versus capital markets, identify key financial instruments, T-bills, CP, bonds, stocks, derivatives, explain the 2008 financial crisis and its effects, recognize the functions of financial institutions, FIs, understand financial market regulation and risk management, describe financial globalization and its impact on the Philippines. Why do we need to study financial markets and institutions? Markets and institutions are primary channels to allocate capital in our society. Proper capital allocation leads to growth in societal wealth, income, economic opportunity. What are financial markets? Financial markets are one type of structure through which funds flow. Financial markets can be distinguished along two dimensions, which includes primary versus secondary markets, money versus capital markets, primary versus secondary markets. Primary market, where companies raise capital by issuing new stocks or bonds to investors, involves first-time issuance before the securities are traded in secondary markets. Example, Mon Nissan's IPO on the PSE in 2021. In the diagram, the bank acts as an underwriter, connecting the corporation issuing new securities to institutional investors, who then offer them to individual investors. And secondary market is where existing stocks or bonds are traded among investors. Includes exchanges, for example, New York Stock Exchange or NYSE, in the Philippines, Philippine Stock Exchange or PSE, and over-the-counter markets. Example in US is NASDAQ. Example OD secondary market in the Philippines is buying or selling Jollibee, JFC, shares on the PSE after its IPO. In the diagram, you can see the OTC market connects fund managers through investment banks. On the right, a fund manager wants to sell, routes through an investment bank, trades via OTC. On the left, another fund manager wants to buy, supported by investment bank sales, trading, and research, also trades via OTC. Now, let's understand what was the financial crisis that happened in the year 2007 to 2008 in the United States of America. The financial crisis was a global economic meltdown caused mainly by risky housing loans in the U.S. banks gave out too many loans that people couldn't repay. When many borrowers defaulted, major banks and financial institutions collapsed. This led to panic, falling markets, and a credit freeze, making it harder for companies to raise funds. Let's now reflect on the impact of the crisis by asking key questions about how it affected the primary and secondary markets and what role these markets play in society. During the financial crisis, the primary market was hit hard. Investor confidence dropped dramatically and companies struggled to raise funds. Many had to delay or cancel their IPOs and bond offerings because people were simply too afraid to invest in anything new. Now, some might ask, do secondary markets really add value? Or are they just a legalized form of gambling? The truth is, secondary markets do play an important role in the economy. They make it easier for investors to buy and sell, helping manage risk and liquidity. While speculation exists, most investors are in it for the long term, and their activity supports business growth and capital flow. Finally, it's important to see how the two markets are connected. The existence of a strong secondary market actually makes the primary market work better. When investors know they can sell their investments later, they feel more confident buying new stocks or bonds. This encourages more participation and helps companies raise the money they need to grow. Now, let's understand the difference between money markets and capital markets. Money markets are where short-term debt securities are traded, those with maturities of 1 year or less. Common examples include treasury bills and certificates of deposit, or CDs. These investments are generally low risk, meaning there's little chance of losing your capital. But because of that safety, the returns are also quite low. On the other hand, capital markets deal with long-term instruments, both debt, like bonds, and equity, like stocks. These investments usually have maturities of more than 1 year. They offer the potential for higher returns, but with that comes a greater risk of capital loss. So, in simple terms, money markets offer safety with low returns, while capital markets involve more risk, but the chance for higher rewards. Let's look at some common money market instruments, which are short-term, typically 1 year or less. First, we have the Certificate of Deposit, or CD. This is a deposit placed in a bank for a fixed period, say 6 months or 1 year, and it earns interest. However, if you withdraw the money before it matures, you'll usually pay a penalty. Then there's the negotiable CD. This is similar to a regular CD, but issued in large amounts, often 1 million Cuban pesos or more. What makes it different is that it can be traded or sold to other investors before it matures, making it more flexible for large institutions. Another key money market instrument is the Treasury bill, or T-bill. T-bills are short-term debt issued by the government to raise funds. They have maturities of less than a year, typically 91, 182, or 364 days. Instead of paying interest like a regular loan, T-bills are sold at a discount and paid back at their full face value when they mature. For example, you might buy a T-bill for 98,000 Cuban pesos, and after 1 year, you receive 100,000 Cuban pesos. That 2,000 Cuban pesos difference is your profit. T-bills are considered very safe, short-term, and highly liquid, which is why they're widely used by investors and financial institutions. Now let's look at capital market instruments, which are used for long-term financing, typically more than 1 year. First, we have debt instruments like bonds. Bonds are basically loans made by investors to a government or a company. In return, the borrower pays regular interest and repays the full amount at the end of the term. Pushpin, a good example, is retail treasury bonds, RTBs, issued by the Bureau of the Treasury here in the Philippines. Next, we have equity instruments, which refer to stocks. When you buy a stock, you're actually buying ownership in a company. Stockholders can earn dividends and also benefit if the company's stock price increases. Pushpin, a familiar example, would be Jollibee Foods Corporation, JFC, stocks, which are traded on the Philippine Stock Exchange, PSE. Now let's take a look at the money market instruments outstanding in the U.S., measured in trillions of dollars. Treasury bills, T-bills, which used to dominate the money market, now make up only 1/5 of it. This shows a steady decline in their use since 2016. Bankers' acceptances are also becoming less common. They're often used in international trade, where a bank guarantees payment if a buyer doesn't pay. But because they're expensive and newer, faster trading methods are emerging, they've been used less over time. The commercial paper CP market, on the other hand, crashed during the financial crisis and has been recovering slowly. CP works like a short-term loan from investors to large, creditworthy companies, helping them cover expenses without borrowing from banks. Now let's take a look at the capital market instruments outstanding in the U.S., measured in trillions of dollars. One key indicator is the Dow Jones Industrial Average, DJIA, a major stock market index that tracks 30 large, well-known U.S. companies like Apple, Coca-Cola, and McDonald's. During the financial crisis, by March 2009, the Dow had plunged by 53.8%, even worse than the 1929 crash. But there was a strong rebound. By April 2010, the market had recovered by 71.1%, signaling renewed investor confidence and economic recovery. By 2016, corporate stocks became the largest component of the capital market. Meanwhile, mortgages lost share, likely due to the housing crisis fallout. Corporate bonds rose until 2010, but slightly declined afterward. Treasury securities dipped in 2000, but recovered by 2016. This shift shows how investor behavior and market structure changed after the crisis. Let's compare the U.S. stock market and the Forex market in terms of trading volume. The U.S. stock market sees about $550 billion traded per month. In contrast, the Forex market handles around $7.5 trillion every single day. That means the Forex market is nearly 400 times larger than U.S. equities, showing just how massive, liquid, and globally important it is in the world of finance. Let's talk about the foreign exchange market, or FX market. The FX market is where people trade one currency for another. For example, exchanging US dollars for Japanese yen. There are two main types of FX transactions. Spot FX. This is the immediate exchange of currencies at the current exchange rate. It's fast and happens on the spot. Forward FX. This is when two parties agree to exchange currencies in the future on a specific date and at a rate decided today. It helps manage risk when dealing with future payments in foreign currencies. When we look at the most traded currencies in the global foreign exchange market, the US dollar USD stands out by far. It's involved in about 88% of all trades, making it the dominant global currency. The euro comes next, participating in roughly 30% of transactions, followed by the Japanese yen JPY at around 17% and the British pound GBP at about 13%. Other major currencies, like the Chinese yuan CNY, Australian dollar AUD, Canadian dollar CAD, and Swiss franc CHF, each account for about 4 to 7% of trading volume. This shows how central the USD is to global finance, often acting as the bridge between other currency pairs. Please watch part 2 of Module 1 to continue learning about financial systems and markets. Don't forget to like this video, subscribe to the channel, and hit the notification bell so you won't miss future lessons.